Do you want to minimize the amount of taxes you pay in retirement? If so, then crafting a tax-efficient withdrawal strategy from your 401k or other pre-tax retirement accounts is absolutely critical. In today's video, we're going to go through a case study of a high-earning couple that has a significant amount of assets in pre-tax 401k accounts and examine ways that they can minimize the income taxes over their lifetime. And make sure you watch to the very end, where I'll give you 4 key takeaways that you can use to craft your tax-efficient withdrawal strategy. Hi, my name's JP Geisbauer, founder of Centerpoint Financial Management. I'm a certified financial planner professional, a certified public accountant, and this channel is dedicated to helping diligent savers maximize their lives and minimize taxes as they transition into retirement. So let's go ahead and dive right in. Here's the scenario. We've got a husband and wife, age 60 and 55 respectively. Each plan to retire at age 65 and claim Social Security at their respective full retirement ages of 67. Each currently earn $200,000 per year. They have 2 adult children which have graduated from college, are self-sufficient, and have high income potential. Currently, their expenses are about $10,000 a month, and they would like to maintain the exact same lifestyle in retirement. They have $150,000 in cash. They have $1 million each in their respective 401k accounts. Up till now in their life, they have focused on enjoying life with their kids, traveling when they can, funding as much of their 401k as possible, and paying for their children's college education. However, now that the husband's reached age 60 and the wife is age 55, they've become very focused on planning for their retirement. So here we are in case study mode. Now, I've entered this information, but let's make sure that we're all on the same page here. So where I like to start with that is the personal balance sheet. So as you can see, based upon the scenario that we established, they have $150,000 of cash in a current checking account. They each have $1 million in a pre-tax 401k account. And then they own their primary home that has a fair market value of $1.5 million. So all in, their net worth is about $3.7 million, of which $2 million is pre-tax retirement accounts. Okay, so here what we're looking at is basically their income over the rest of their lives. So let's walk through this really carefully. On the left-hand side is basically their annual income, and then on the bottom is their ages. So 60 to 95. What we have here is basically the blue is the salary and income, right? Remember, they are both age 60 and 55. The husband's retiring at age 65, as well as the wife. Now, the 70 here is just the husband's age, but since she is 5 years behind, that's why that's happening. She's 65, he's 70, and at that point in time, both of their wages stop. So if we look at that, we can kind of see what happens after their wages stop, right? We've got some Social Security, which is the green, and then some investment income, which is the blue. But the vast majority of their income after they retire is the orange. And what the orange is, that is the required minimum distributions that they're going to have to take from their pre-tax retirement accounts. So if you kind of look at the way the sawtooth graph here goes, you've got them pulling money out at age 70, kind of make the ends meet. And then at 75, they have the first tranche, which is the husband's required minimum distributions starting to be due. And then at age 80, that's the wife's RMDs starting at age 75. So you've got this situation where once they start taking required minimum distributions, there's not a whole heck of a lot you can do. They are in the glue, and they're just going to have to take those required minimum distributions until they die. Now, there is an option called the qualified charitable distribution. I'll save that for another video. But just know for now, once they start having to take required minimum distributions, they're just going to have this income coming at them with little recourse for what they can do to try to mitigate the tax effects of it. What I want to look at here is the actual detail behind the numbers. So let's walk through this very quickly just to refresh our minds of the scenario. The husband and wife are earning $200,000 a year plus salary increases up to the husband's age 65. So then we see that at 2029. We see significant income drop right there because that is essentially when the husband's income stops. Then in 2031, when the husband becomes full retirement age, he begins to take his Social Security income. So we see a little bump up, right, between 2030 and 2031. Then the next big drop happens in between 2033 and 2034, and that's when the wife stops working. So we see a significant drop off in income from the 344 to the 87. Now, 2 more years down the line is when she recognizes Social Security, right? Because remember, we said that she's going to retire at age 65, but then claim Social Security at a full retirement age at age 67. So at this point in time, in year 2036, they're both receiving their Social Security benefit. And it happens for a couple years, and then in 2039, this is when the husband's required minimum distributions start, right? So that happens in 2039. And then in 2044, that's when the wife's required minimum distributions start. So that's kind of the lifespan of what's happening here going forward. So I want to point out here between 2034 and 2039 kind of what's happening. They've both stopped their wages. Only the husband's taking Social Security for the first couple of years. And what's happening is we see negative cash flows here. So they're going to need to make that up from somewhere. So this graph here is essentially a graphic representation of the Excel spreadsheet we just saw in the previous screen. What we can do here now is let's focus on the ordinary income tax brackets. So this is where we're going to start planning around what is the best way to do this. Now you'll recall when we were on that cash flow worksheet that they're going to have 5 years where they're not making enough money. So they're going to have to either liquidate some investments, pull some money out of their 401k account in order to make the ends meet essentially. So one way to do this is via a pro rata distribution. And what that essentially means is they're going to take an equal distribution between the pre-tax amount and the after-tax amount. They don't have any tax-free amount, recall, because they were never able to contribute to the Roths during their working years. So we really only have those 2 buckets to work with. So we'll start with the pro rata amount. So let's try something differently. Rather than taking the pre-tax amount, let's take as much as we can from the after-tax account. So that in this instance, that would be basically the taxable first, then the tax deferred, and then the tax-free. Again, we don't have any tax-free. So when we hit refresh and it updates the numbers, here's what happens. By electing not to take money from the pre-tax in those years when we needed to make up the deficit, we save almost $1 million in tax-adjusted ending assets. So here's a little bit more meaningful. This is the actual tax that we saved. So if you look at the blue here, the blue would be basically the pro rata strategy. The green says taking from the taxable account first, then the 401k account. So just that little switch results in us saving a projected almost $600,000 in taxes at the federal level. And you can kind of see it, right? Because if you look at the green here, the green is the tax that you're going to have to pay on the non-pro rata strategy, and the blue is the one behind it. So you can kind of see how bigger the blue mass is when compared to the green. But let's not stop there. That's only one component of this. Now, by taking this strategy and not having that income from the withdrawals, we can see that between age 70 and 75, we've got a massive dip in income. So let's do something here. Let's take a look at what we would do to fill the tax brackets. So really quickly, this blue mass here is basically the taxable income. And then these lines across here basically show what the tax rates are at those certain levels. So as you can see, we've got the 10%, then the 12, 15% is the green, the 22, 25 is the yellow, and finally the 24, 28 is the orange. So let's start filling these tax brackets up, right? Because If we look here, when they're in their 80s, they're going to be at a way higher tax bracket. But right here, they might have an ability to fill this up to save some money and pay tax at a lower rate. So let's do this really quick. Let's fill up the tax bracket. They're already at 10, so let's go up to 1215. What does that do to the ending assets? Well, the ending assets now all of a sudden raised to $1.3 million. So they've increased that by almost $200,000 just by being tax efficient here. But I think we still got some more room to go. Let's move this up one more tax bracket to 22 and 25%. Look at that. That gives us an adjusted ending asset balance of 1.8 higher than the pro rata strategy. So by not doing pro rata and doing aggressive Roth conversions, we have a tax-adjusted ending asset balance that's going to be $1.8 million higher. Let's go back to the federal tax paid again. So this now includes everything, right? This includes both the Roth conversions up to the 22% tax bracket, and it includes not doing pro rata distributions. So as you can see, the green has shrunk considerably. So that difference relates in almost $1.2 million in less federal taxes paid because of that strategy. Now you might be saying, well, nobody really does a pro rata strategy anyway, and that could be potentially a valid criticism. So comparing apples to apples as far as the distribution strategy, doing those Roth conversions resulted in a lower lifetime tax liability of about $650,000. Taken over 35 years, that's like $18,000, $19,000 a year in less taxes. So this is the importance of having a tax-efficient withdrawal strategy if you've got a significant pre-tax retirement account balance. So now that we've gone through this scenario, here are the 4 key takeaways that you should have when you're trying to plan for your own tax-efficient withdrawal strategy. Number 1, don't use some pro rata rule or some other rule of thumb when it comes to funding your retirement. Use a strategy that will meet your cash flow needs, but will also be tax efficient. Number 2, take advantage of low tax earning years and do Roth conversions. The years between when you stop working and when you're forced to take required minimum distributions can be an excellent opportunity to do these Roth conversions. Number 3, don't only look at your tax liability on a year-by-year basis, but also look at it over your entire lifetime. If you have a large pre-tax retirement account balance, you're going to need to take RMDs, and chances are they are going to be significant. Get your arms around what the tax implications of those RMDs are going to be, and begin to see if it makes sense for you to recognize some of that income earlier via Roth conversions. Number 4, be thoughtful when you make the determination about whether you're contributing to your 401k plan with Roth or pre-tax dollars. The couple in our scenario used pre-tax dollars almost exclusively, and given their level of income, that probably made sense from an income tax perspective. But if they had made the decision to fund Roths as opposed to pre-tax accounts earlier on, they wouldn't have to contend with these large required minimum distributions. So if you're watching this video and you're either early or midway through your career, make sure you're making thoughtful decisions regarding whether or not to fund pre-tax or Roth. That decision can have a huge impact on your retirement planning. In this scenario, our couple has significant balance in their pre-tax 401k account. I did a video about what you should do with your 401k plan when you retire. If you're interested in learning more about that, you can watch that video here. If you've made it this far, thanks for watching. If you enjoyed this video, please hit like or subscribe. Thanks again for watching, and I'll see you next time.